Well, good morning. So, the topic of the day is proposed changes in the Insurance Act 1938. Proposed changes in the Insurance Act 1938. See, the Insurance Act of 1938 was enacted during a time when the insurance industry in India was still in its nascent stage. So the British government recognized the need to regulate the growing number of insurance companies operating in the country and ensure the protection of policyholders' interest. The legislation was a significant step towards bringing transparency, stability, and reliability to the insurance sector. Insurance is a crucial aspect of modern life, providing individuals and businesses with financial protection against unforeseen risks. So in India, the insurance industry has a rich history with its foundation laid by the Insurance Act of 1938. This landmark legislation established the framework for the regulation and governance of the insurance companies in the country. So, this Act has key provisions, and the key provisions of the Act are the licensing and registration, because this Act mandated that all the insurance companies operating in India must obtain a license from the Insurance Regulatory and Development Authority of India. This provision aimed to ensure that only credible and financially stable insurers could offer their services to the public. Then solvency of margin. The Act introduced the concept of solvency margin, which required insurance companies to maintain a minimum level of capital and assets in proportion to their liabilities. This provision was crucial in safeguarding the interest of policyholders and maintaining the financial stability of the insurers. Then there is a tariff advisory committee. The Act established a tariff advisory committee responsible for fixing and regulating premium rates for different types of insurance policies. This committee played a vital role in preventing unfair pricing practices and ensuring affordability and accessibility of insurance products. And the most important one is policyholders' protection, because the Act emphasized the protection of policyholders' interest by mandating the creation of separate funds for policyholders' benefit. It also specified provisions for the settlement of claims, ensuring that policyholders receive their due compensation in a timely manner. The Insurance Act 1938 has made impact on the insurance industry because it strengthened the regulatory framework. The Insurance Act of 1938 laid the foundation for a robust regulatory framework, ensuring the efficient functioning of the insurance industry. It established a framework for licensing, solvency requirements, and oversight, which continues to be refined and enhanced in subsequent legislations. So, promoting consumer confidence, the Act focuses on policyholders' protection, and the establishment of stringent regulatory standards helped build trust and confidence among consumers. This in turn encouraged more individuals and businesses to opt for insurance coverage, leading to the growth and expansion of the industry. And then the evolution and adaptation. While the Insurance Act 1938 has undergone several amendments over the years, its core principle of regulation and policyholders' protection have remained intact. So the Act served as a solid foundation for subsequent insurance laws, shaping the development and evolution of the insurance industry in India. That means the Insurance Act of 1938 played a pivotal role in shaping the insurance landscape in India while introducing essential provisions for licensing, solvency, tariff regulations, and policyholders' protection. So the Act laid the groundwork for a well-regulated and consumer-centric insurance industry. Its legacy continues to endure with subsequent legislation building upon its principles to meet the evolving need of policyholders and insurers. The Insurance Act of 1938 stands as a testament to the importance of the effective regulations in fostering a thriving and trustworthy insurance sector. Now, in a major step towards achieving insurance for all, by 2047, the government plans to introduce a transformative bill in the upcoming budget session or in the next session to amend the Insurance Act 1938. This amendment aims to modernize the regulatory framework, expand insurance coverage, enhance competition, and drive economic growth. So the Insurance Act 1938 has long been central to India's insurance regulations, but modernization is needed to align with evolving market dynamics. In December 2022, the Finance Ministry sought public feedback on proposed changes to the Insurance Act and the Insurance Regulatory Development Act 1999. So the experts highlight that while proposals like captive insurers and subclass registrations are promising, others such as single insurance registration and insurance distributing financial products need further clarification. So the draft bill pending cabinet approval represents the beginning of a broader regulatory overhaul, shifting towards a principle-based regulatory regime. Now let us see what are the key changes in the proposed bill. The first one is increased delegation of powers to IRDAI. The Amendment Act enhances the IRDAI's authority by defining class of insurance business and subclass, allowing the IRDAI to categorize various insurance segments like motor and credit insurance. So the IRDAI is granted broad powers to regulate registration, minimum capital and solvency margin for these subclasses. Second one is introduction of composite licenses. Under the Insurance Act 1938, the life insurers are restricted to offering life insurance products, while general insurers can provide non-life products such as health, motor, fire, and marine insurance. The RDAI does not allow composite licensing for insurance companies, which means that an insurance company cannot offer both life and non-life products as one entity. The new bill proposes the introduction of composite licenses, allowing insurers to offer both life and non-life products. This would enable life insurers to underwrite health and general insurance policies, breaking down the existing compartmentalization of insurance services. Now, different capital requirements. The third one is different capital requirements. Means existing regulations impose uniform capital requirements on all insurance companies, regardless of their size or scope. So the bill suggests differential capital norms, which would allow different levels of capital investment based on the scale and focus of insurance companies. The fourth one is the reduction in solvency norms. Means insurance companies are required to maintain a certain solvency margin to ensure they can meet their future obligations. The amendment seeks to reduce these solvency norms, potentially lowering the financial barriers for new entrants and encouraging a more competitive markets. The fifth one is issuance of captive licenses. Means the bill may include provision for issuing captive licenses, allowing organizations to set up their own insurance companies to cover their specific needs. This could announce self-insurance capabilities and risk management for large corporations. The sixth one is changes in investment regulations. The Amendment Act proposes that the IRDI will set all investment requirements and restrictions for insurers through regulations rather than having these prescribed in the Insurance Act and its current regulations. This shift aims to streamline and adapt investment norms more flexibly. So the Amendment Act also raises the threshold for IRDI approval of share transfers from 1% to 5% of an insurance company's paid-up equity capital. This increase simplifies the process for smaller investments and facilitates easier market participation. The seventh one is one-time registration for intermediaries. The bill proposes a one-time registration process for insurance intermediaries, streamlining their entry into the market and reducing bureaucratic hurdles. The Amendment Act allows for the perpetual validity of insurance intermediary registrations such as corporate agents and brokers upon payment of an annual fee set by RDI. Previously, these registrations were valid for only 3 years and required renewal every 3 years. The eighth one is net owned funds. Means the Amendment Act proposes to lower the net owned funds requirement for foreign insurers from INR 5,000 crores to INR 500 crores. This significant reduction aims to enhance the attractiveness of the Indian market for foreign reinsurers, particularly smaller and new age players, addressing a long-standing request from global reinsurance firms. Ninth is expansion into financial products. Insurers may be allowed to distribute other financial products, broadening their services offerings and integrating more financial solutions under one roof. And the last one is electronic submissions. Means the Amendment Act aims to improve business efficiency by allowing the electronic submission of returns required under the Insurance Act. The IRDI will set the submission frequently through separate regulations, enhancing ease of compliances. Now the question is, how will the Insurance Amendment Bill impact the industry? Because the amendment aimed to improve return for policyholders and enhance their overall experience while facilitating access to a wider range of insurance products and services. By allowing composite licensing and reducing capital and solvency requirements, this will is expected to encourage the entry of more players into the insurance sector. Now, the entry of new insurance companies and the expansion of existing ones are likely to spur economic growth and create job opportunities across the country. The proposed changes are designed to enhance both operational and financial efficiency within the insurance industry, making it easier for insurers to do business and better manage their business. See, the Insurance Act of 1938 is a legislation enacted in India to regulate the functioning and operations of insurance companies in the country. It establishes a framework for licensing, solvency requirement, tariff regulations, and policyholders protection. So the Act was introduced to address the need for regulations in the growing insurance industry of India during that time. It aimed to protect the interest of policyholders, ensures financial stability of insurers, and promote transparency and reliability within the sector. Now, some key provisions of the Act include licensing and registration requirement for insurance companies, the establishment of solvency margins to maintain financial stability, the creation of a tariff advisory committee to regulate premium rates, and the emphasis on policyholders' protections. Now, the Insurance Act 1938 had a significant impact on the insurance industry. It strengthened the regulatory framework, promoted consumers' confidence, and facilitated the growth of the sector. The Act laid the foundation for subsequent insurance laws and continues to shape the insurance landscape. Now, this is the high time to amend because major proposed changes are there, and it's upon the government to give a final approval for all these things for smoothening and streamlining the insurance industry of India. Thank you very much.